Our next learning objective is OCF, sales volume and break-even. So what's the general break-even quantity? Someone took a P&L or an income statement and solved for Q. Q, again, is in units. The units are units. How many units do I need to make and sell just to break even? So all three types of break even follow this format. Q equals fixed cost plus OCF over contribution margin, or P minus V. You'll see that contribution margin, P minus V, in all three break even scenarios. Counting break even is simply fixed cost plus depreciation over P minus V. Here, OCF is equal to depreciation, and we can prove that very simply because EBIT is 0, taxes are 0, and MPAT is 0. So in every case, OCF will be equal to 0 plus depreciation minus 0. And that's why you get break-even quantity of fixed cost plus depreciation over P minus V. Here's a really good example. So here is a break-even situation. Very simply, my sales equal my cost. You're left with 0 EBIT, 0 tax, and 0 NPAT. And to do the OCF on this accounting break-even situation, it's EBIT plus D minus T. EBIT is 0, D is whatever D is, no matter what it is, and minus taxes of 0. So at the accounting break-even, OCF will always be equal to depreciation. So just remember that when plugging into that general break-even quantity equation. Don't forget, contribution margin is P minus V. In all of these are break-even quantities. Interest expense not considered in this calculation. Why do we use accounting break-even? You'll see it used in just about every company you'll go to work for. It's very simple to calculate. It's the point at which the boss will want to know how many units do I need to make and sell just to break even on an EBIT basis. EBIT 0, taxes are 0, NPAT is 0. What's kind of the minimum quantity I need to make and sell? So it's very popular in practice. And this is the one you've known how to do possibly since you've been in high school. It's the point where sales equal cost. Very simple. You break even in a financial sense and in an opportunity cost sense. Selling price of a CD is $19.99. Check your understanding. Variable costs are $9.99. What's the contribution margin? We know the contribution margin is simply selling price minus variable cost per unit. And in this case, it's very easy to calculate $10. A very, very important concept because we want to know if we enter this project, if we're covering our fixed costs, we're making any contribution toward fixed costs. And in this case, we would be. So very, very important that you remember contribution margin. What does it mean when a project breaks even on an accounting basis? OCF is equal to D, as we proved on the earlier slide. And in this case, when it just breaks even, we have 0 EBIT, 0 tax, 0 MPAT. We end up with a negative net present value. So we would generally reject that project. What's OCF in accounting break-even? We've proven it's equal to depreciation. So please remember that very important concept. Cash break-even point is the point where OCF equals 0. So the sales level I need to make and sell just to break even on an OCF basis, OCF equals 0. So fixed cost plus 0 over P minus V will be the break-even quantity. And basically, you're just covering your fixed cost. So this is a very low number of units. As an IRR of minus 100%, something the CFO is not going to want to see. Fixed cost plus 0 over P minus V. And as I said, that results in a very small number of units to break even just on a cash basis. And we'll see an example of that in a minute. And then the highest quantity, the highest break-even quantity is financial break-even quantity. It's kind of a new concept. Same format, fixed cost plus OCF over contribution margin, P minus V, so the same general equation. So this is the financial break-even quantity is the quantity of units I need to make and sell to break even to get a 0 net present value. So it's a little bit more complex. I have to do a little bit of discounting. So this break-even point is higher than both the accounting break-even and the cash break-even point.